Welcome to your market brief for the week of April 20th. Stocks are coming off a second straight week of gains amid hopeful reports for a COVID-19 treatment and as the U.S. takes tentative steps towards reopening the economy. As Wall Street continues to maneuver ongoing volatility and troubling economic data, let's turn to Anastasia Amoroso with JP Morgan Private Bank for guidance. Anastasia, great to see you on this Monday morning.
Good morning. Good morning to you.
So let's start with the headlines. First up, crude. Prices are plunging, demand is cratering. This would normally, I would think, be a huge negative for the market. What's your take?
I think what's reflected in the crude market, it's what's otherwise reflected in the broader markets as well. And that is just simply the fact that the demand has been exceptionally weak. And the demand is going to come back over a number of months, but obviously that's not happening right now. What the crude markets are clearly reacting to this month and next month is a massive supply demand imbalance. And demand is projected to crater by something like 23 million barrels a day in April before easing up a little bit in May. So the thing about the crude markets is the OPEC plus cuts definitely helped, but they didn't help enough. What they essentially tried to address is the tank storage and make sure that we don't have an overflow situations for those tanks. What they did not address is the whole demand side of the issue. So that's why we're seeing this weakness in the front couple of months. But as you think about return to normal activity, and once again, that's what's being reflected in the broader markets, you should have a little bit of the demand move a little bit higher in May and resume a little bit more in June. So by the time we should be deep into the summertime and in August, we actually think that the crude market can flip from this massive oversupply to a deficit situation. So that's why
So
I
would,
don't necessarily see a disconnect between the two.
so would that correspond with an economic recovery then? Because there's a lot of talk about when we do finally start to recover, what that recovery will look like. What's your take?
Yes, absolutely corresponds with the recovery, and the expectation is that slowly but surely we'll start rolling back the lockdown restrictions. I think what's pressed into the market is that we don't fully ease up in May, maybe some places do, but some level of activity will really start to come back in earnest in June. And by the way, looking to China as a template, we know that we don't go from 0 to 100, we go to 20, 30, 50%, and eventually probably the reality is 80%. Not really the full snapback. And this is why when we look at the shape of the recovery on a year over year basis, it may look like we're projecting a V-shaped snapback, but the reality is this is going to be a little bit slow to return on a quarter over quarter basis.
In terms of other headlines, a new round of funding for the government's small business relief program could be decided upon today. This, of course, comes as some 22 million jobs were lost in the last 4 weeks. Really troubling numbers. Do you think an additional $300 billion will be enough to kind of stem the bleeding? We need small business to really help, be the engine for our economy.
I'm not sure that it's going to be fully enough given this tremendous demand out there, but this certainly helps. When we look at the small businesses who wanted a loan and small businesses who got a loan, we know that there is a massive mismatch between the two. So I do think this 300 some plus $billion top up definitely would help additional businesses get the program. And what I've been really encouraged by and amazed by in the last just really month or so is the degree of cooperation that is taking place between the federal government and also the monetary policy, and the fact that the two work together, and the loans that are being issued by through the federal government programs, the fact that the Fed is stepping in and providing additional liquidity for those through those programs is really important. So I think it's a step for sure in the right direction.
Anastasia Amoroso, thanks so much for joining us.
Thank you.
Now let's shift to a preview of the week ahead. Major companies reporting quarterly results include Chipotle, Coca-Cola, and Netflix on Tuesday, AT&T and Delta on Wednesday, Citrix, Intel, and Southwest Airlines on Thursday, and then American Express and Verizon on Friday. We'll be closely watching Netflix. It's one of the best performing companies in the S&P 500 this year as consumers remain at home binging on streaming services. On the economic calendar, we'll get data to further clarify challenges facing the U.S. economy related to inflation and the housing market. And of course, we'll continue to closely monitor weekly claims for unemployment insurance, as well as fresh data on manufacturing and durable goods. Now, sticking with volatility, I recently spoke with Nancy Davis. She's Chief Investment Officer for Quadratic Capital Management and one of Barron's 100 most influential women in U.S. finance. We discussed how investors can hedge in this climate with exposure to fixed income and through her ETF iVol, which offers investors access to interest rate changes. We began by discussing why U.S. markets could retest recent lows. Watch this.
I definitely think we could retest those lows. I think especially in the growth segment of the market, like if you look at the NASDAQ, it's pretty much back to where it was in December. And we have no idea yet how quickly, I think it's really second quarter earnings that are going to matter more. First quarter earnings, if you think about when the shutdown really took place, we still had, the economy for the most part running in the first quarter. So I think it's definitely a treacherous time for investors. At the same time, you don't want to be, going to cash and not being invested for the long term. So that's why I think having diversifying strategies such as potentially eyeball to help diversify your portfolio so you're not just all in stocks, but you can keep your exposure, but also have other things that might help diversify if things get a little wonky.
Obviously, you've been touting iVol, but are you focused more on the fixed income exposure because equities are too risky right now, or they're too expensive, or what is it?
I think the reason I'm so focused on the fixed income markets is usually the rates market is the leader. The rates market is usually, I would say, the smartest market out there. Usually rates move first, meaning the government bond markets, the OTC rates market, then you have credit, then you have equities last. And so I'm very focused on the fixed income markets to see what market expectations are, what probability distributions are, and the bond market is really screaming that we're in a dire situation still. I do think the Fed should be focused on getting the 10-year yield actually higher. That's a bit of a contrarian view. Most people, like, not all interest rates are created equal. So lower front-dated policy rates is really great, and we need to stimulate the repo market, the commercial paper market. 3-month LIBOR is still way too high, so we have a lot of funding issues, but you actually want a steep yield curve to give health to the banking system. So think about if you were lending money to somebody else, you would want to have, why would you make a long-dated loan or a 2-year loan or a 5-year loan if you're not being compensated for it? And also a lot of the risk parity models, which look at the trade-off between equities and bonds, they look at the 10-year as the risk-free rate. And so when the 10-year currently is around 60 basis points, it's never been more expensive in price terms and have a lower, the yield hit, I think 0.39 in March. That was the absolute most expensive, highest yield ever, but still at 60 basis points. The 10-year, I think, would be healthier for the market if it was actually higher, because it would trigger to the risk parity models that asset allocate between bonds and equities to say, hey, it's time to go more risk on. Now, it's definitely a different view than most people have, but I don't think, policy rates and funding rates need to be low. And I think the Fed still has some more work to do.
My thanks to Nancy Davis. That concludes today's Market Brief. As always, stay safe, stay healthy. I'm Caroline Woods. Thanks so much for watching.